Hello there, this is forexbrokers.net, and the following 3 videos deal with double combinations with the Elliott Waves Theory. This is a live example of a possible double combination. I'm not saying that it is a double combination indeed, but a double combination that follows all the rules. And the idea here, as I mentioned throughout the article available on our Trading Academy, the idea is to put together a live example, or actually you will see 2 live examples of a double combination, and the theoretical part laid down by Ralph Elliott almost 100 years back, 3/4 of a century back, and then to see the differences between what the theory says and how a double combination looks like in reality. On this first video, let's review a bit the theory. A double combination, in this case we talk about a double combination that starts with a zigzag, A, B, C, X wave, A, B, C, D, E. So this would be our double combination. But in theory, the theoretical part, a double combination looks like this. You have, to start with, you have a wave A. Let's use the same labeling that we have here. This is the euro and the US dollar price action. So you have a wave A, and at this point in time, when the market goes to wave A, we don't know as traders what the pattern will be. The market pulls back, and it's very important to interpret this pullback. If this pullback goes beyond 61.8 out of the previous segment, the market forms a flat or a triangle. If this pullback goes less than 61.8 of this wave A, the market forms a zigzag or a triangle. If this pullback then is followed by another impulsive move like this, then it becomes clear that the market didn't form a triangle, but the market forms a zigzag. Because of the B wave, the B wave is unable to retrace more than 61.8 of wave A, it implies that this is a zigzag. And at this point, imagine that we don't know what's to follow in terms of price action. And at this point, everything we know points to simple correction. For a simple correction, as we mentioned throughout the Trading Academy on different articles, for a simple correction, the market needs to confirm the simple correction. So in order to say that this ABC is a zigzag, it's a simple correction, we need to see the price action reversing completely the C wave in less than the time it took the C wave to fall. In other words, what we gotta do is to take a shape or use whatever other tool to measure the time, to project it on the right side from the end of the C wave, and then to see if the price action that follows does this. If it does this, then this is a simple correction, and we cannot talk about a double combination or any kind of a complex correction involving at least one X wave. But if the market, let's say that it retraces a bit, but if the market goes like this, or maybe even like this, it retraces well into the territory of this corrective wave, corrective ABC, but fails to respect the time element. It means that it doesn't confirm the ABC as a simple correction, and this ABC in reality is a complex correction or part of a complex correction. The first thing to consider in a complex correction is a double combination, because double combinations are the most common complex corrections forming on the currency market. And if you ask me, not only on the currency market, but on commodities as well, on stock indices as well, and so on. Assuming that the market retraces and doesn't confirm that it's a simple correction, we have a bias that we should look, the first thing to do, we should look for a complex correction with an X wave. So we should take an X wave or an intervening X wave to put it here it is important for the X wave not to retrace more than 61.8 of the previous A, B, C, and that would be the intervening X wave, or the X wave that connects the first correction with the other one. Most of double combinations end up with a triangle, especially on the currency market. Sometimes they don't end with a triangle, they end with an opposing, or a structure that opposes the first correction. If this is a zigzag, due to the fact that the B wave failed to retrace 61.8, then the second correction can be either a triangle, most likely, or a flat, less likely. So the pattern goes here something like A, B, C, D, E, and that would be the end of the triangular pattern. If we apply then the labeling A, B, C, like this, then we take the D wave and the E wave, so A, B, C, D, E, and then if we use two trend lines to connect the B to D and the A and C to see the triangle, then it becomes obvious that this entire pattern from here to here, this entire pattern from here to here is nothing but a double combination. We should let me delete these ones from the screen, so not to confuse things at this point in time. There you go. So this is how a double combination appears on theory, within the part of the Elliott Wave Theory. And this is a double combination that starts with a zigzag and ends with a triangle. You can have a double combination that starts with a flat and ends with a triangle. One that starts with a zigzag but ends with a flat. One that starts with a flat but ends with a zigzag. But you cannot have ever a double combination or a triple combination or any kind of complex correction, as a matter of fact, that starts with a triangle. So it is mandatory that a complex correction begins with a flat or with a zigzag. Let's move on with the interpretation of a real life example and to provide more details. Bye bye.